Hey, good morning, everybody. Welcome to America's Retirement Headquarters. Good to see you guys again. It's been a while. I haven't done a video for a minute and missed you guys. So wanted to get out there today and talk to you about the walloping we got yesterday in the stock market and talk to you a little bit about why it matters that a Chinese development company, which we will, for now, because of compliance purposes, will remain unnamed, could have effects on your stock market here in the United States. And I want to talk about that, as well as maybe some of the other issues that have kind of been lingering in the US economy that have contributed again to this long list of other issues that as investors we need to kind of maintain and kind of keep an eye on. So hopefully you're having a good day, and welcome to Trends at 10. My name is Chaz Price. I'm a certified financial planner. And so yesterday, the market was down over 600 points. It had actually started down as high as 900 points from our high. Now let's keep this in perspective. The last 3 weeks, the market has been down. This is probably on pace to be the first down market for a month we've experienced since January of this year. So what happened? Well, as I had mentioned, the Chinese development company, one of the largest in their country, has signaled that they may not be able to make a debt payment coming up at the end of this month. So if you are a student of the market, you'll know that in China, their growth of the last 20 years has really been spurred on by development, infrastructure spending, both commercially and residentially. And so this company is one of their largest. They owe about $300 billion. And, a lot of that development and a lot of that infrastructure spending and growth has been fueled with debt. And so recently, China has really been cracking down on lending practices, borrowing that companies can do, and just cracking down on business in general, particularly to the technology companies. And so as kind of the well started to dry up, if you will, for debt in China, this large development company has suffered to the extent that one of my old mentors would say they're choking on their own debt. Is essentially that. So they may not be able to make their payments come the end of the month, and they're hoping that the Chinese government will bail them out. Whether or not they will is still to be determined. And so the question you're probably having is, okay, that's fine. What does it have to do with my stocks in the United States? Good question. Well, first of all, we're just not really sure on how all these chips are going to lay. We know that, kind of similar to the way that the Lehman Brothers company did back in 08 and 09, where just kind of really flared up the housing crisis. We're concerned that this company in China, because of its size, could have kind of some spreading effect, or the contagion effect, if you will, that could filter through other parts of China and maybe cripple their economy in general. And so we're also concerned about, and again, going back to that, China is the second largest economy in the world. So that's going to have global effects regardless. Also, we're concerned that, we just don't know who owns the debt of that company in the United States. And so again, we're not sure what really is going to happen. In addition to that, like I said, it's just one more thing to add to a long laundry list of concerns and issues that investors in the United States are facing. First and foremost, the Delta variant. And we read yesterday where some major airlines are starting to see a lot of bookings being canceled. I saw yesterday or actually this morning on WNPR, I was listening, where I think the COVID deaths have exceeded 675,000, which is more than the flu pandemic of 1918. In addition to that, the Federal Reserve is going to be meeting. They've already talked about bond tapering, basically that quantitative easing, or removing money from the system to try to slow inflation down. So they're taking us off life support, the Fed is. And then once again, we're bumping up against the debt ceiling. That is to say that if the government by October 1st, by the end of September, if they don't pass a new budget, which is the end of the fiscal year, and start one in October 1st, we may not be able to have the government running. The government may be running on limited resources, if not shut down. So there's just been a lot. In addition to that, the market's been up for the last 11 years. And so we've kind of been looking for this opportunity. So just wanted to kind of calm your fears a little bit. The market's already showing like it's going to be up today. It's going to get a sharp rebound. So don't be scared away. That is the theme for today. Don't be scared away from markets like this, particularly in September and October. September and October are the weakest months of the year for whatever reason historically. We call it in the investment world the October effect. The October effect is the psychological predisposition or anticipation of a bad stock market in October over any other month. So if you're old enough and you lived through the black market crash in 1987, you would know that that was a bad day in October. Also, the 2001, the market following the attacks on the World Trade Center was terrible. Also, the 2008, 2009 was kind of started, the Great Recession was started there in October 2008, or at least gets credited with it. And so October is a seasonally bad month, and it is not disappointing this month either. So, but don't be scared away. We've faced markets like this before, and we've recovered, and we will do so again. So what can you do as an investor during a volatile, choppy market like this? Well, first and foremost, hopefully you've been raising cash over the last 6 to 12 months, and so that you have some dry powder ready to go in and buy when stocks are on sale. Secondly, what you can do is you can start to look to upgrade your positions. What do I mean by upgrading positions? Well, maybe you have a couple stocks or a couple investments that you purchased what we call is on the fly. You really you didn't do the research, or maybe they just weren't making any money at the time. There may be a newer company, have a lot of debt, something like that, but you like the idea, you like the story, you wanted to get in, everybody's told you to get in, maybe there was a friend at work or something that recommended it, and it's just not panned out, it hasn't done anything. Now's the time to really probably look to upgrade. Buy something that has some cash on the books. And this time, in a market like this, cash is king. So look for companies that have really strong balance sheets and cash. Look for companies that have little to no debt. And look for companies that are profitable, companies that are making money. The other opportunity is you could look for companies that are everyday essentials. Now, everyday essentials are companies that if you open your drawer or your cupboard in the house, you'll probably see their products right there. You use them on an everyday basis. And by focus, as an investment advisor that focuses on working with retirees, those two categories of investments are really the extent of what we're going to look at when we're looking for stock investments. We're looking for companies that have, everyday demand, inelastic demand, so that if it's a $6, cost, you're going to still buy it. If the Big Mac goes up to $7, right? You're still going to buy it. You're still going to need soup and paper products and, household items and things like that. So look for companies that have inelastic demand. Look for companies that are profitable and are making money, okay? And don't be scared away from a market like October. It happens historically, it's just a bad time, but we will also get through that. So I just wanted to talk with you guys for a second today, give you a shout out, and we look forward to talking to you again. Thanks a lot. That's your Trends at 10 today. Have a great day.